By the mid-2010s, Blue Apron had become one of the most closely watched subscription startups in the United States, while investors increasingly believed the company represented the future of home cooking, food delivery, and direct-to-consumer commerce. The company's core idea initially looked highly attractive and deceptively simple. Blue Apron delivered pre-portioned ingredients and step-by-step recipes directly to customers through recurring subscription meal kits designed to simplify cooking at home. Instead of planning meals, shopping for groceries, measuring ingredients, and organizing recipes manually, customers could receive complete meal kits delivered directly to their doors every week. At first, the model appeared perfectly aligned with major consumer trends shaping the modern economy. Convenience spending was rising rapidly. Subscription businesses were becoming extremely popular across technology and consumer markets, and younger urban consumers increasingly embraced app-driven services promising efficiency, personalization, and recurring delivery convenience. Investor excitement surrounding Blue Apron accelerated aggressively as the company expanded subscriber growth, fulfillment operations, marketing campaigns, and national distribution infrastructure at enormous speed. The company quickly became one of the largest meal kit providers in the country, while venture capital and Wall Street increasingly viewed Blue Apron as a major direct-to-consumer growth story with massive long-term potential. At its peak, the company's valuation climbed into the billions, while Blue Apron expanded warehouses, logistics systems, packaging operations, and refrigerated food distribution networks across the United States. Externally, the growth looked extremely convincing. Subscriber numbers expanded rapidly, revenue surged, and the company increasingly positioned itself as a technology-driven platform capable of fundamentally reshaping how households purchased and prepared food. But underneath the growth narrative, Blue Apron's system was becoming far more operationally complex and financially fragile than many investors initially understood. Every new subscriber did not simply create more revenue, it also created more ingredient sourcing pressure, packaging complexity, refrigerated shipping costs, customer service obligations, and delivery coordination risk across the company's rapidly expanding logistics network. The deeper Blue Apron scaled, the more the company was discovering that running a nationwide subscription-based meal kit system involved enormous operational pressure underneath the convenience-driven growth story presented to investors and consumers. What initially looked like a revolutionary subscription platform was gradually becoming a business increasingly dependent on expensive logistics, constant customer acquisition, and operational precision simply to sustain growth momentum at national scale. Blue Apron's entire business model depended on a very specific assumption that large-scale subscription meal delivery could generate stable recurring customer revenue while maintaining enough operational efficiency to support long-term profitability. The process initially appeared highly scalable on the surface. Customers subscribed to recurring meal plans through Blue Apron's platform, selected weekly recipes, and received refrigerated meal kits containing pre-portioned ingredients delivered directly to their homes. For consumers, the model felt modern, convenient, and personalized. The company removed grocery shopping, meal planning, recipe organization, and ingredient preparation from the cooking process, while positioning itself as a simpler alternative to traditional food purchasing behavior. For investors, the opportunity initially looked even larger. Blue Apron appeared to combine multiple high-growth business trends simultaneously, including subscription commerce, direct-to-consumer logistics, recurring revenue systems, data-driven personalization, and convenience-driven consumer spending. At first, investor excitement largely focused on subscriber growth and revenue expansion. But the deeper Blue Apron scaled nationally, the more the company was beginning to discover that sustaining recurring meal kit subscriptions at massive scale was operationally exhausting, retention-sensitive, and far more expensive than the original hypergrowth narrative had assumed. As Blue Apron expanded deeper into the subscription economy boom, investor excitement surrounding the company accelerated rapidly across Wall Street and the broader technology market. Subscriber numbers surged aggressively. Revenue growth expanded at extraordinary speed, and the company increasingly positioned itself as one of the leading businesses attempting to modernize how households purchased and prepared food in the United States. By 2017, Blue Apron had become one of the most recognized names in the meal kit industry, while investors valued the company at billions of dollars during the height of subscription commerce optimism. Externally, the growth narrative looked extremely convincing. The company expanded warehouse infrastructure, fulfillment operations, cold chain logistics systems, packaging facilities, and nationwide delivery capabilities to support rapidly increasing customer demand. At the same time, Blue Apron aggressively increased marketing spending and customer acquisition campaigns in order to sustain subscriber growth momentum against rising competition inside the rapidly expanding meal kit market. What initially looked manageable during early expansion was gradually becoming much more operationally expensive underneath the surface. Every new customer required recurring food sourcing, packaging coordination, refrigerated shipping, recipe planning, warehouse labor, delivery timing precision, and continuous customer service support every single week. Unlike software platforms that benefited from lightweight scaling economics, Blue Apron's system became physically heavier and operationally more demanding as subscriber volume expanded nationally. That structural pressure became increasingly dangerous because many customers did not remain subscribed long enough to offset the enormous cost required to acquire and serve them profitably over time. Large numbers of subscribers eventually paused subscriptions, skipped meal deliveries, or canceled entirely after short usage periods. Some customers became exhausted by recurring cooking routines. Others returned to grocery shopping, restaurants, or emerging food delivery alternatives entering the market during the same period. As subscriber churn increased, Blue Apron increasingly needed expensive marketing campaigns and promotional spending simply to replace departing customers and maintain growth momentum. The deeper the company expanded, the more Blue Apron's system started behaving like a subscription engine, constantly fighting operational complexity, rising customer acquisition costs, and retention instability underneath the hypergrowth narrative presented to investors. What initially looked like a revolutionary recurring revenue platform was increasingly becoming a business where sustaining growth required enormous ongoing spending and operational precision simply to prevent the system itself from slowing down. By the time Blue Apron approached its 2017 public offering, many of the structural weaknesses underneath the company's hypergrowth model were becoming increasingly difficult to ignore across the market. Externally, the business still appeared highly successful. Subscriber numbers remained large, revenue scale looked impressive, and Blue Apron continued positioning itself as a technology-driven subscription platform capable of reshaping long-term consumer behavior around home cooking. But underneath the expansion narrative, the economics of sustaining that growth were becoming far more fragile. Customer acquisition costs were rising aggressively as competition inside the meal kit and food delivery industry intensified rapidly across the market. At the same time, Blue Apron still depended heavily on expensive refrigerated logistics systems, fulfillment infrastructure, packaging operations, food sourcing coordination, and nationwide shipping precision simply to maintain weekly subscriber activity. That combination created enormous operational pressure underneath the company's growth story, because large portions of customers were still canceling subscriptions, pausing meal plans, or leaving the platform before generating enough long-term value to offset the high cost required to acquire and serve them profitably. The deeper Blue Apron pushed subscriber expansion, the more the company found itself trapped inside an increasingly expensive cycle requiring continuous marketing spending simply to replace churn and sustain growth momentum. What initially looked like recurring subscription stability was increasingly behaving like a retention-sensitive system, constantly leaking customers underneath the surface. At the same time, Blue Apron was also facing mounting pressure from rival meal kit providers, including HelloFresh, Home Chef, Plated, and other rapidly expanding subscription food competitors entering the market during the same period. Traditional grocery retailers were improving online ordering systems and prepared food options, while food delivery platforms increasingly reduced the need for consumers to cook recurring meal kit subscriptions consistently at home. Then Amazon announced its acquisition of Whole Foods in 2017, dramatically increasing investor concerns surrounding competition across grocery delivery, food logistics, and direct-to-consumer commerce. The announcement created a major shockwave because Amazon already possessed enormous warehouse infrastructure, delivery systems, logistics scale, subscription reach through Prime, and fulfillment capabilities that smaller meal kit companies could not easily match. Investors increasingly feared that if Amazon aggressively expanded deeper into food delivery and grocery convenience, Blue Apron's long-term competitive advantage could weaken significantly underneath the surface. The company still possessed enormous operational scale and national visibility, but underneath the surface, the hypergrowth system that once looked revolutionary was increasingly becoming difficult to stabilize financially as customer churn, acquisition costs, logistics pressure, and competitive threats intensified simultaneously. After Blue Apron's 2017 public offering, the gap between the company's hypergrowth narrative and the underlying economics of the business started becoming far more visible across Wall Street and the broader subscription economy market. Investor excitement surrounding subscription meal kits weakened rapidly as concerns surrounding customer churn, operational costs, and long-term profitability intensified after the IPO. Blue Apron's stock declined heavily from its earlier market optimism, while confidence surrounding the company's original growth thesis deteriorated across Wall Street. The company still operated at enormous scale, but underneath the surface, the operational burden required to sustain that scale was becoming increasingly exhausting, financially and operationally. At its peak, Blue Apron was serving hundreds of thousands of subscribers through massive nationwide fulfillment systems, meaning even small increases in customer churn, shipping costs, or operational inefficiencies could create increasingly dangerous financial pressure once scaled across the entire network. Massive fulfillment centers continued processing refrigerated ingredients, recipe coordination systems, packaging operations, warehouse labor, cold chain logistics, and nationwide deliveries every single week under constant timing pressure. Every shipment carried ingredient sourcing costs, packaging expenses, refrigeration requirements, shipping pressure, spoilage risk, and customer service obligations simultaneously. At the same time, subscriber retention instability continued damaging the economics of the business underneath the surface. Large numbers of customers still paused subscriptions, skipped deliveries, or canceled meal plans entirely before generating enough long-term value to justify the high acquisition and fulfillment costs attached to the system. Many customers also started questioning whether recurring meal kit subscriptions justified the long-term cost and commitment compared to grocery shopping, restaurant delivery apps, and rapidly improving online grocery services entering the market during the same period. Some consumers initially enjoyed the novelty of cooking meal kits at home, but eventually became fatigued by recurring cooking routines, weekly subscription schedules, and the higher pricing attached to the service. That created a dangerous structural imbalance. Blue Apron increasingly needed expensive marketing campaigns and promotional spending simply to replace departing subscribers and maintain growth momentum, while portions of the customer base continuously leaked out of the system underneath the surface. The company was no longer scaling like a lightweight technology platform. It was increasingly behaving like a physically heavy logistics operation, trapped underneath fragile retention economics, expensive fulfillment systems, and operational pressure that could not easily be removed because the logistics infrastructure itself was the business. Competition intensified further as HelloFresh, grocery delivery systems, food delivery apps, supermarkets, and Amazon's expanding food commerce ecosystem increasingly weakened Blue Apron's once unique convenience advantage. What investors once viewed as a revolutionary direct-to-consumer subscription platform was increasingly being reevaluated as an operationally exhausting logistics business, struggling to maintain durable long-term economics at national scale. The deeper analysts examined Blue Apron's retention rates, fulfillment costs, acquisition spending, and operational complexity, the more many started questioning whether the company's hypergrowth model could ever realistically generate stable long-term profitability. As Blue Apron's operational pressure intensified, the company's original hypergrowth narrative started collapsing much more visibly across Wall Street and the broader subscription economy market. What investors once viewed as one of the future leaders of direct-to-consumer food commerce was increasingly being reevaluated as a retention-sensitive logistics business struggling to sustain profitability at national scale. The company's stock continued falling sharply from its earlier post-IPO expectations, while billions of dollars in market value disappeared from the company's peak-era optimism. Subscriber growth slowed, customer churn remained persistent, and Blue Apron increasingly faced pressure from investors demanding a clearer path toward long-term profitability and operational stability. At the same time, the company still carried enormous operational obligations underneath the surface. Warehouses continued operating under constant fulfillment pressure. Perishable ingredients still required precise sourcing and refrigerated transportation. And nationwide logistics systems still demanded expensive coordination every single week, regardless of whether subscriber retention remained stable. That created one of the most dangerous structural problems inside Blue Apron's business model. The company's operational infrastructure had been built aggressively for hypergrowth scale, but the retention economics supporting that scale were becoming increasingly unstable. Over the following years, Blue Apron reduced operations, cut costs, restructured parts of the business, and attempted to stabilize the company as the original expansion narrative weakened across the market. What initially looked like a revolutionary subscription platform capable of permanently reshaping home cooking behavior was increasingly being viewed as a business overwhelmed by expensive logistics, fragile retention economics, and scaling complexity. The company itself did not disappear completely. Blue Apron continued operating afterward in reduced form, while the broader meal kit industry survived in smaller and more competitive conditions than many early investors originally expected. But the original hypergrowth thesis that once convinced Wall Street subscription meal kits could scale into massively profitable recurring revenue systems at national scale had largely collapsed. What ultimately damaged Blue Apron was not the absence of consumer demand for convenience. The deeper failure came from building a growth system where customer retention weakened faster than operational complexity, fulfillment costs, and acquisition spending could realistically be controlled at massive scale. The company succeeded at generating rapid subscriber growth, but the same expansion system that fueled Blue Apron's rise simultaneously created a physically heavy logistics network and fragile retention structure that became increasingly difficult to sustain profitably over time. Blue Apron's rise and decline ultimately became one of the clearest examples of how subscription hypergrowth can become structurally fragile when operational complexity and customer retention weaken underneath the surface simultaneously. At its peak, the company convinced investors that recurring meal kit subscriptions could permanently reshape how households purchased, prepared, and consumed food across the United States. The growth story initially looked extremely convincing. Subscriber numbers expanded rapidly, revenue surged, warehouses scaled nationally, and billions of dollars in valuation were created around the belief that subscription-based food delivery represented the future of consumer convenience. But the deeper Blue Apron expanded, the more the company discovered that scaling recurring meal kit subscriptions was far more operationally expensive and retention-sensitive than the original hypergrowth narrative had assumed. Every new subscriber increased logistics pressure. Every cancellation weakened long-term customer economics, and every expansion phase required increasingly expensive fulfillment coordination simply to maintain operational stability underneath the surface. The company succeeded at building massive infrastructure, but sustaining profitable long-term subscriber behavior across that infrastructure became increasingly difficult as churn, acquisition costs, shipping expenses, and operational demands intensified simultaneously. What initially appeared to investors as a lightweight, technology-driven subscription platform was ultimately operating more like a physically heavy national logistics business dependent on fragile recurring customer behavior. The system generated enormous activity, but activity alone was not enough to guarantee durable long-term economics once retention instability and operational exhaustion started spreading through the business at scale. Even after the collapse of its original hypergrowth narrative, Blue Apron itself continued operating afterward in reduced form, while the broader meal kit industry survived in smaller and more competitive conditions than many early investors originally imagined. But the original vision that once convinced Wall Street subscription meal kits could scale into massively profitable recurring revenue systems at national scale had largely collapsed. The story was never simply about consumers losing interest in meal kits. It was about a subscription growth system discovering that rapid expansion, fragile retention economics, expensive logistics infrastructure, and operational complexity could become extremely unstable once scale intensified faster than long-term business durability. Blue Apron did not fail because the company lacked growth. The company failed because the same hypergrowth engine driving subscriber expansion was simultaneously building an increasingly expensive, retention-sensitive, operationally exhausting system that became progressively harder to sustain profitably over time.